What is up, guys? My name is Nash and welcome back to another video. Today I'm going to be talking about how I pick my dividend stocks. This is going to be focused on how to pick the safest and the best dividend stocks that you can find. So it's not necessarily talking about how to pick the highest paying dividend or the lowest or whatever. But this is heavily focused on the safety of the dividend, right? Most people that invest in dividend stocks, they're looking for cash flow, right? So if you're looking for cash flow, you want it to last for as long as possible. So you're not looking to sell this stock in the next, 2 or 3 years. Why sell it if it's providing you with cash flow? So you want to find a safe dividend that is not going to get cut. So as a side note, if you are new to dividends, it is important to know that companies are not required to pay you dividends. That means that they can take them away anytime, which means they can cut them or they can reduce them. So it comes down to finding a company that has the least potential to cut their dividend or to reduce their dividend, which is really hard to do, honestly, because sometimes you have perfectly fine companies that end up cutting their dividend because of things like Corona that nobody expected. So now they don't have enough money to pay their bills. So the first thing they do is cut the dividends because they're not legally obligated to pay out dividends. The goal is to find companies that are safe, and by safe I mean companies that are least likely to cut or reduce dividends. So when I'm looking for dividend paying companies, I look for 4 different things. The first thing that's obvious that everyone looks at is the dividend yield, right? So you want to look for a great dividend yield. So the dividend yield is pretty much a company's annual dividend divided by the stock price. So this means it changes over time because the stock price changes like literally every minute. So a common mistake that a lot of people make is actually they chase the dividend yield, right? So when it comes to dividend yields, you want to stay between 2 and 4%, 2 being the lowest. So you kind of want to aim for the lowest to be 2% and the highest you have to be 4%. So if you find anything that's above 4%, that's when you should do more research. So you want to be able to understand why they have such a high dividend yield. So I'm going to go over the other things that you would need to look at, but the dividend yield is the first thing that a lot of people look at because that's how much you're going to get paid essentially. Alright, so let's say you find a healthcare company that has a 2% dividend yield and you're not really sure if this is too high or too low for the healthcare industry. So what you can do is you can actually look for the average dividend yield for the healthcare industry. And if a company is within that average, so that's how you know it's a good dividend yield. So some industries naturally have a high dividend yield. So you want to keep that in mind when you look at dividend yields. All right, so the next thing is not really important, but it's something that I like to look at. That's going to be the annualized payout. So this is pretty much how much you're going to get paid in dividends per year. Of course, you get paid every 3 months or every quarter. All right, so the reason I like to look at the annualized payout, I really hate looking at percentages because they don't really tell you the dollar amounts. But when I look at the annualized payout, it tells me over the year the company is going to pay me $1.20, and that kind of like helps me visualize because I'm not looking at percentages, I'm looking at dollar amounts. So it kind of like puts things into perspective. Not really important, but for me, I like to visualize. I don't like looking at percentages. All right, so the next thing is going to be the payout ratio. So this is probably the most important thing on this list because the payout ratio is going to tell you the percentage of how much the company is paying out in dividends, right? So that's going to be the percentage of the profits. So if a company has a payout ratio of 80%, that simply means that they're paying 80% of their profit in dividends, right? And the remaining 20% is what gets reinvested into the business. So reinvesting into the business is what makes the business grow. It's what makes companies expand. They can reinvest into the business by creating a new location in a different country, which in turn means more profit. So if a company is not reinvesting into themselves, and they're just paying that money to dividend investors. So this means that the payout ratio is not sustainable because if they're paying you 80%, they have no room to grow that dividend because how far can they go? Are they going to go to 90%, 100%? And there are companies that have payout ratios of 100%, which is really dangerous because they're reinvesting $0 into the business. So when you're looking for payout ratios, you want to look for something that's, below 60%. You can go up to 80%, it's 80% is okay and below, but at the highest that I try to go for is pretty much at 60%. You should aim for something that's below 80%. All right, so the last thing is going to be the dividend growth. So the dividend growth is measured in years. So it will tell you how many years the company has been consistently increasing dividends every year. When it comes to this, there are 2 categories. You have dividend kings and you have dividend aristocrats. So dividend aristocrats are companies that have been paying dividends for 25 years, I believe. And dividend kings have been paying dividends for 50 years. And keep in mind, they're not just paying dividends, they have to increase the dividend every single year. So that's how they get to be on this list. So an easy way to find, great companies, just look up dividend aristocrats, and you know that the companies in that list have been paying dividends and increasing dividends. And this pretty much helps with trusting the company actually. So if a company has been paying dividends, let's say for 60 years, this means that they're obviously doing something right. And most of the time, they're not going to do anything to ruin that reputation. Because imagine breaking a 60-year streak of increasing dividends and you just cut them out of nowhere. Because as soon as you cut the dividend, they kick you off the list. And surprisingly, a lot of people pick stocks by looking up those lists, and they just buy stocks in that list. So this kind of like gives the companies exposure. So when it comes to this, the only thing you want to avoid is pretty much companies that don't have a dividend growth history. And those are the 4 things that I look for when I'm trying to find dividend stocks. So hopefully that helps you pick great companies. So thank you so much for watching, guys. Make sure to go ahead and hit the subscribe button below if you haven't already. And I'll see you on the next one. Peace.